Okay, hi there, Jeff here with a quick video looking at the economics of fixed exchange rates, and in particular just trying to draw out some of the key advantages and disadvantages of operating a currency peg. So a fixed exchange rate is of course different to a floating system, and it exists when there is a hard or semi-fixed currency peg. We use the word peg where you choose a value for the exchange rate. We also use the word of anchor. So fixed currency peg. The central bank of the country is charged with having and using foreign currency reserves to intervene in currency markets. So for example, if the currency is under threat, under selling pressure, they would go into the market and be buying up their own currency, selling foreign currencies to do that. If the currency was in danger of appreciating or going too high, to maintain the fix, they go into the market and sell their currency and buy foreign currencies in exchange. So they have to intervene in the currency markets if they want to maintain a fixed exchange rate. Trade in goods and services takes place at the official exchange rate, although of course there's often, as we know in many countries, unofficial trades. Unofficial trade in goods and services, unofficial capital flows in shadow or grey currency markets. That's the nature of the world. Hong Kong dollar is still pegged at the moment to the US dollar. The Bulgarian lev, Bulgaria is inside the European Union, inside the single market, but outside the Eurozone. Their currency, the lev, is pegged to the euro. It's fixed. So what are the relative advantages of using a fixed exchange rate? You might want to take a moment to press the pause button, maybe jot down what you think are the main advantages. Here are three. Often there's some overlap, but let me try and pick out the key points here. First of all, if you have a fixed currency, you have a more stable currency in theory, and that creates more certainty for lots of things. It creates uncertainty for overseas investors. If you're going to buy, if you're a European investor, thinking about buying Bulgarian government debt, for example, then you know that the lev is fixed to the euro, so there's less currency risk. If you're thinking about buying some property in Bulgaria, you know that the currency is fixed to the euro, so the value of that property won't suddenly diminish in terms of the foreign currency risk there. So it creates more certainty for investors, and also it creates certainty for exporting businesses. If you know what the currency is going to be against your major trading partner, again, that reduces some of the risk of investing ahead of exporting, if that makes sense. And if this is a synoptic question, you choose an industry where you think that's quite important. Fixed currency, especially if you fixed against a relatively low inflation country. What I mean by that, an economy where the average rate of price increases is fairly low. A fixed exchange rate can help to keep costs and prices under control. You see, if you've got a fixed exchange rate and you're a business that's exporting against a low inflation country, you can't let your costs go out of control because you'll just become less competitive month on month, year on year. It's often said, for example, if you have a fixed exchange rate, then you have to keep your costs and prices in line with that of rival firms in the fixed exchange rate countries. Businesses, though, will benefit from improving productivity. If you can achieve unit labour cost reductions by becoming more productive, that should show through straight away in terms of being able to sell at a lower price in overseas markets if you have a fixed exchange rate. Whereas with a floating exchange rate, the currency can move up and down, and you don't necessarily get those direct benefits. Crucially, if you have a more stable currency, then that brings down the costs of what's called currency hedging. So currency hedging is when you maybe have to buy your currency some months in advance because you're not worried about the risk of the currency moving in the wrong direction. Think about airlines that buy their fuel in advance. Well, for the fixed exchange rate, in theory, there's less need to hedge against that. And a stable currency should also increase demand for tourism because, again, overseas tourists know pretty much what their holiday is going to cost, and also the relative purchasing power of their currency when they come to visit your country. So quite a few small countries, the Bahamas is a good example, they have a fixed exchange rate against the US dollar. As always in economics, though, there are some drawbacks, some disadvantages, some risks of having a fixed exchange rate. First of all, you've got to have the foreign currency reserves to be able to control your currency, and many low and middle income countries simply do not have the currency reserves. They suffer from a currency gap, and therefore they they really can't maintain their currency because they don't have the wherewithal to do it in terms of the central bank intervening. And even if they were to change interest rates, the sheer weight of global currency flows means they're basically price takers in world markets, and they really don't have any significant interest rate or intervention control over their exchange rate. Second point is crucial. If you fix your exchange rate, what it means is that the exchange rate becomes part and parcel of your monetary policy, and you're essentially taking away the ability to manage the exchange rate through a managed floating system. So if you move to manage floating, for example, you could then use interest rates and intervention, maybe to move the exchange rate in another particular direction. Maybe your economy is at risk of recession, and you might want to achieve a 5% depreciation. Maybe the economy is at risk of deflation, in which case you want a currency reduction. Or maybe your economy is overheating, and you might want the exchange rate to be stronger to prevent excessive inflation. So if you have a managed floating system, a hybrid system, that gives you more freedom, opportunity, if you like, or latitude to use interest rates. And often, if you have a fixed currency, it can be out of line with economic fundamentals. So if you've got depending on the value of the currency peg, if it's too high, if the exchange rate has been fixed too high, oftentimes imports become cheaper, don't they? Strong pound, imports cheaper, exports dearer. So if the currency is fixed too high, imports flood into a country, and it's much harder to export. If the currency peg is set too low, exports benefit, but it becomes very expensive to import the things you need, such as fertilizer and pharmaceuticals and capital goods. So finding the right level for a fixed exchange rate is really important. Don't forget, of course, there are two types of fixed exchange rate. You can have a fully fixed system, or you can have a semi-fixed system. So China has tended to go for semi-fixed, whereas the Bulgarian lev is fully fixed against the euro. Now, the latter allows some movement of the currency from day to day. Of course, it is possible to revalue or devalue the exchange rate. It is not fixed forever, although a competitive devaluation can sometimes really annoy your trade partners, your neighbours, and that can invite retaliation, for example, through import tariffs. If you peg to the US dollar, don't forget most world commodity prices are priced in dollars. And that means that a change in the world commodity price of coffee or cocoa or zinc or whatever it is, oil and gas, that's going to feed straight through to your economy, so which might increase the risk of imported inflation. And maintaining a high fixed exchange rate during a time of recession invites deflation, and that can be very costly, as we know. In fact, deflation can be as costly as inflation. Hopefully useful. If you enjoyed the video, please give it a like. We really appreciate it, and we don't take it for granted. So hopefully this was a useful, quick session on fixed exchange rates. Stay healthy, stay happy, stay curious. All the best to you, and see you soon.